Gildan Media presents Your Coach in a Box, affordable, life-changing audio programs. The Little Book of Bullseye Investing: Finding Value, Generating Absolute Returns, and Controlling Risk in Turbulent Markets, by John Mauldin, narrated by Pratt. An Introduction to Bullseye Investing. Would you tell me, please, which way I ought to go from here? That depends a good deal on where you want to get to, said the Cheshire Cat. I don't much care where, said Alice. Then it doesn't matter which way you go, said the cat. Just as long as I get somewhere, Alice added, as an explanation. Oh, you're sure to do that, said the cat, if you only walk long enough. Lewis Carroll. Alice's Adventures in Wonderland. Every hunter knows you don't shoot where the duck is, you shoot where the duck is going to be. You've got to lead the duck. If you aim where the duck is at the moment you shoot, you'll miss it. Bullseye investing simply attempts to apply the same principle to the markets. In this book, I hope to give you an idea of the broad trends that I believe are at work now and will persist for the remainder of this decade. Then I'll help you target your investments to take advantage of those trends. Through the Looking Glass. When I was invited to do this little book of bullseye investing, I wondered whether the original Bullseye Investing, written 9 years ago, and dense in data and research, and not little at all, could be shortened and still deliver what put the book on the bestseller lists and earned it the top spot on Forbes publisher Rich Karlgaard's Roll Call of the Decade's Most Important Books on Investing. It has since been published in several foreign languages and is still in print. Thinking about doing the little book made me go back and carefully read the original, and I was pleased to find how much of it is still useful today. Much of the research that it reports is timeless and still will be valuable a generation from now. Many of the predictions, whether by luck or skill, were spot on. We are still on the path I mapped out, but are much further along it. The task for the little book is to collect the parts that have held up well and then bring things up to date, and introduce new readers to the concept of bullseye investing. As I write this introduction, the final element, I've just come from Hong Kong, where bullseye investing has something of a serious following. Publishers are eager to do a Chinese-language version for distribution in Hong Kong and the mainland. The principles of the long-term ebb and flow of markets really do work wherever human beings are involved in investing, which is to say, everywhere. Successful investing for the remainder of this decade will mean doing things differently from what people did so profitably in the 1980s and 1990s, and from what Wall Street is still telling people to do. We started the last bull market in 1980 with high interest rates, very high inflation, and low stock market valuations. All the elements were in place to launch the greatest bull market in history. The environment now is just the opposite. Stock market valuations are still relatively high, though well down from the stratosphere where they were flying at the beginning of the decade, and interest rates will eventually have to go up. In addition, gold is volatile, as is the dollar against other currencies, and the twin deficits of trade and government debt stare us in the face. Everything is not relative. So, which way is the stock market going? And how about bonds? Gold? Real estate? Where should you invest? Wall Street and the mutual fund industry say, the market is going up. You should buy stocks, and now is the time to do it. You can't time the markets, so you should buy and hold for the long term. Don't worry about the short-term drops, and my best advice is to buy my fund. Wall Street is like the carpenter who only has a hammer. Everything looks like a nail. Those brokers are in the business of selling stocks because that is how they make their real money. Whether they are sold one by one, or packaged in mutual funds, or as IPOs, or in wrap accounts, or in variable annuities, or in derivatives, what the brokers want to sell you is some type of equity stock, and preferably today. They have rigged the rules against investors who would prefer more and safer choices, so that most investors are unaware of the options. Their advice for you to buy what they're selling has been their same advice every year for a century, and it has been wrong for about half the time. There are long periods when stock markets go up, but there are also long periods when markets go down, or sideways. And by long, I mean longer than almost anyone is prepared to wait. These cycles are termed secular bull and bear markets. Secular, as used in this sense, is from the Latin seculum, which means a long period of time. Each cycle has its own good investment opportunities. When I wrote the introduction to Bullseye Investing in 2003, I said we were entering a secular bear. Now, 9 years later, we are in the latter part of that same trend. The problem with Wall Street is that most of what it sells does poorly in secular bear markets. So most traditional portfolios have suffered since 2000, but they still tell you that things will get better, so buy and keep buying. Just look at this chart prepared by our independent economists that proves the market will go back up. Just have patience and please, give us more of your money. In secular bull markets, an investor should search for assets that offer relative returns, stocks and funds that will perform better than the market averages. If you beat the market, you're doing well. Even though there will be losing years, the strategy of staying invested in quality stocks during a secular bull market will be a long-term winner. In a secular bear market, however, that strategy is a prescription for disaster. If the market goes down 20% and you go down just 15%, you'd be doing relatively well, and Wall Street will call you a winner. Your broker would expect a pat on the back, but you're still down 15%. In markets like those we face today, the essence of bullseye investing is to focus on absolute terms. Your benchmark is a money market fund. Success is measured by how much you make above Treasury bills. Some will say, as they say each year, that the bear market is over, and that the book you are listening to is about ancient history. But experience says otherwise. A secular bear market can see drops much bigger than we have already been through, and it can last as long as 20 years. The shortest has been 8 years. None has ended with valuations as high as they were at the bottom of 2009. And that touches on one of the novel ideas in this book. Bull and bear cycles should be seen in terms of valuations, not price. Investors who continue to listen to the music from Wall Street will be sorely disappointed, in my opinion, as the facts I will present show that this bear market has years to go. For buy-and-hold investors planning to retire within a decade and live on their stocks, the results could be particularly devastating. Walking long enough. Bullseye investing is not, however, about doom and gloom. Despite what Wall Street wants you to believe, there is no reliable connection between how the economy does and how the stock market performs. As we'll see, the economy should muddle through with just the usual kind of recessions sandwiched between periods of growth. The world as we know it is not coming to an end. It is merely changing, as it is always doing. There are numerous possibilities for investment growth while the secular bear market proceeds. You just won't find them on any standard Wall Street menu. What I hope to do is give you a roadmap to the future by looking at how and why markets have behaved in the past. We will debunk many of the myths and so-called scientific studies used by Wall Street to entice investors into putting their money into buy-and-hold, relative return investments. As should be no surprise, they use facts, theories and statistics that are carefully selected and in many cases plain wrong. And when the market goes down, they just shrug their shoulders like a Chicago Cubs fan, or, my own case, Texas Rangers, and say, "Wait till next year, and buy some more, please." Chapter 1. It's good to be king, but beware of tailors using invisible cloth. The traditional wisdom of Wall Street is to buy low, sell high. While it sounds simple enough, the philosophy has fostered an entire industry of financial advisors, prognosticators, and experts. When you reflect on the carnage on Wall Street in the last few years, it's easy to place stock market experts in the same category as TV weathermen. Television shows parade a seemingly endless lineup of financial, economic, and stock market experts who freely give this stock tip or suggest that investment strategy. Yes, they say, the economic outlook may seem gloomy, but happy days are right around the corner. This is the time to buy. Every talking head seems to have an opinion. Often a show's producer will recruit talking heads with conflicting views and let them battle it out. It can make for interesting viewing for some and confusion for others. How can a few sound bites really give you the information you need to confidently invest in today's volatile markets? Timing is everything. There's a Wall Street legend that Joseph P. Kennedy, the scion of the Kennedy clan, survived the 1929 crash because he had divested all his holdings in the summer of 1929. He said that he knew it was time to get out when he started receiving stock tips from the shoeshine boy. If you were one of the smart or prescient investors who got out of the U.S. stock market before October 11th, 2000, consider yourself lucky. Between 1929 and 1932, the stock market declined 89%, which contributed to the Great Depression. From October 2007 until March 2009, the market lost about 55% of its value, the second biggest decline in our nation's history. The U.S. economy began shrinking in December 2007. The recession, by the technical definition of the term, ended in June 2009 because that's when the economy began growing again. A non-technical definition of a recession's end has to do with consumer confidence and a general sense of optimism about the financial future of the country. We are now in the first quarter of 2012, and people are still looking for solid proof that the worst is behind us. Consumer confidence is at a level typical of a recession, and that is anomalous 2 years into a recovery. Instead of signs of fiscal hope, we are faced with daily reports of continued high unemployment, declining home prices, increasing rates of foreclosures and bankruptcies, persistent federal deficits, high gas prices, and hints of coming inflation. In the face of all the negative news, it would be easy to conclude that investing in the stock market with the hope of making any profit at all would be a fool's errand. You might even believe that the safest course is to stick your money under your mattress and hope your house doesn't burn down. You could do that, but you would be absolutely wrong. With every challenge, there is an opportunity for growth. In the middle of the chaos of war and disaster, there can be a moment of clarity and inspiration in which a hero emerges. We are in the midst of an economic war, and now is not the time to run and hide. Now is the time to take a deep breath, regain your focus, concentrate on your investment target, and pull the trigger. Bullseye! Where were we again? A secular bear market is loosely defined as a period of years or even decades when stock prices are either flat or falling. Think Japan since 1990, or the United States from 1966 to 1982. Historically and classically defined, secular bear markets are as short as 8 years or as long as 17. By a broader definition that I prefer, and will explain, the range is 13 years to as long as 20 years. For the last century in the United States, the length has been remarkably consistent, about 17 years from the beginning of a secular bear to the beginning of the next true secular bull. My friend Art Cashin, head of UBS floor operations and dean and sheriff of the New York Stock Exchange, recently sent me a note he wrote at the beginning of the last decade. It read, "Floor brokers have lots of theories of cycles and such. There's even a fat and lean cycle theory. Just as in the Bible, there were 7 fat years followed by 7 lean years. Brokers claim to see a similar thing in Wall Street. Ours is much longer, 17.6 years. You may think what I am about to tell you is negative. I suggest to you it is not. It raises your opportunity by eliminating mindless competition. It means you have to work at it, seeking advice and information, and not to leave your investment policy on autopilot. That was what folks did in the fat cycle. That doesn't work anymore. In the fat cycle, which ended with the bubble, the Dow went from 900 to 11,700. You could throw a dart and pick a winner. Lots of folks did. Those days are gone. Getting a decent return will be hard work for the next decade. You will need good judgment and good advice. Put the dartboard away. Just so you understand better, let me walk you through this concept. The tech bubble, or the bull market, topped in about February 2000. Just so it works on your calendar, let's call it 2000.2. The Dow is around 11,500. Subtract 17.6 years, and you are in the middle of 1982. The Dow is around 900. It will soon embark on the greatest bull market in history. Subtract another 17.6 years from June of 1982, and you are back to the beginning of 1965. The Dow is around 900. Yes, that's the same area you will find it in 17 years later. This clearly is the lean cycle. The Dow will go above and below 900 at times. Money will be made and new industries will flourish, but it will require skill and hard work to find them. Subtract 17.6 years from 1965, and you are back around the middle of 1947. The war has ended. Smokestack prosperity is in the offing. The Dow is around 220. This was to be a fat cycle. Subtract another 17.6 years, and you are back in early fall of 1929. The Dow is around 380, but not for long. This, clearly, will be a lean cycle. Now, on the slim chance that this is any more than an oddity, what does it mean to you? It means you have to get off autopilot. In a fat cycle, people can almost throw darts and hit a winner. In a lean cycle, they need to pay attention and seek advice from someone with skills and brains. My contention, and I think the clear lesson of history, is that we are still, as of 2012, in a secular bear market that began in 2000. If the recent pattern holds, the bear market will continue for another 5 to 6 years in terms of valuations, if not in price. The key to successful investing will be to hold the types of stocks, funds, and other investments that do well in a secular bear market when valuations are contracting, while avoiding the types that history has shown have less chance for success in such an environment. Understanding the environment and investing accordingly are critical to your success. But before I can tell you how to invest in a secular bear market, you need to understand for yourself what these cycles are and why and how they happen. When past is not prelude. We are looking for clues as to what the stock market is likely to do in the future. If reviewing the past gives us some idea of what the future will be, we will be way ahead of the crowd. We can find some clues in a groundbreaking book by Michael Alexander called Stock Cycles. What he wrote in early 2000 accurately anticipated the behavior of the market since then, and I recommend the book as important reading. You can order it from Amazon.com. Let's jump to the conclusion. Alexander's work shows that using past market cycles to predict the performance of stocks over the coming 12 months isn't much better than flipping a coin. Statistically, from almost any starting point, you have about a 50-50 chance of the market going up or down, using past price movements alone to make your prediction. Even in a secular bear market, the market goes up in 50% of the years, and often quite substantially. But there are certain long-term cycles that are not random, and the probability of those repeating is higher than 50%. As you would expect, the patterns and techniques of useful investing change somewhat dramatically from phase to phase. The trick, of course, is to figure out where you are in the cycle. I have long been suspicious of stock market cycle theory, especially long-wave theory. Long-wave, or Kondratiev wave theory, says the economy and markets repeat every 56 or 60 years. Granted, there seem to be patterns that recur, but there are not enough data points to provide statistical confidence. It is an interesting theory that tells you where you have been and where you are going, but it does not tell you reliably where you are or when you will arrive somewhere else. I remember, as will many of my readers, how long-wave theory predicted the end of the economic world in the late 1980s. How many of you remember the flood of direct mail promotions, not to mention the books, screaming gloom and doom? Obviously, they were wrong. The reason is that analysts try to make long-wave theory a precise predictive model. They do not look at the fundamentals that drive the cycles. It's like watching two men seemingly walk in the same direction in a large city. Maybe they are friends and are walking together. They could be total strangers going to the same location, or they may part ways on the next block. Until you know who the men are and where they are going, using their past travels to predict their movements is simply guessing. It's one thing to use the stars, as the ancients did, to construct a calendar to predict seasons, planting times, and weather patterns. It's another to use the stars to predict personal fortunes. One methodology has a basis in fundamentals. The other, astrology, simply notices patterns that have no causal connection to anything else. Alexander provides, at least for me, the needed link between the patterns of long-wave stock cycles and the underlying economic fundamentals. He shows, as it were, a causal connection between the position of the stars and the seasons. Alexander doesn't claim these cycles are as precisely predictable as the spring equinox. Rather, he suggests that when certain fundamental conditions occur, we can look for spring-like events. Just as you plant certain types of food and plants in spring and certain types in winter, there are some investments that do better in their respective parts of the stock cycle. Carrying the analogy further, it's easier to grow your portfolio in economic spring than in economic winter. In spring, you have a much wider variety of plants from which to choose. You can plant spring crops during the winter, but you're going to have to wait until spring to see them come up. In the meantime, it can be a long, cold season. To help us see what part of the cycle we are in, he first describes several types of stock cycles and then looks at why the cycles occur. First, he takes a purely statistical view of the stock market, looking for repeated patterns. For his purpose, a period when the stock market outperforms money market funds is good, and when it underperforms is bad. Is there any pattern to good and bad? It turns out that the only non-random cycle he can find is a 13-year cycle. Since 1800, there have been 15 alternating good and bad cycles of 13 years, from stocks being undervalued to being overvalued and back again. There was one period where the pattern, instead of reversing, continued for an additional and exact 13 years. The year 2000 was a 13-year peak in his model. There is a probability of only 3.9% that this pattern is random. Alexander's findings suggest that index investors had little hope for capital gains over the 13 years following 2000. Buy and hold investors would probably be better off in cash, just as they were in 1966 and 1929. Simply based on this model, Alexander concluded there is a 75% chance of a negative capital return for index fund investors who hold from 2000 to 2020. However, returns in any one-year period are essentially random. Even in overvalued markets, the odds are essentially even that an index fund will outperform a money market fund in a given 12-month period. Given today's low dividends and high valuations, a money market fund is, on average, a better investment over the next 5 to 20 years than the S&P 500 index. In the case of overvalued markets, like today, holding for longer time periods, even up to 20 years, does not increase your odds of success. Alexander wrote that in early 2000, prior to the first crash. Let me stop here and say that Alexander is not telling us to avoid the stock market. He is simply pointing out, consistently with the theme of this book, that buy-and-hold index investing will not work in the current long-term trend. Simply picking any old mutual fund and expecting a rising tide to raise your boat will give you no more than a 50-50 chance of success in any given year until the secular bear market has run its course. To improve your odds for success, you need a different investment strategy. Alexander looked at the historical cycle of bull and bear markets. He points out that stocks have returned about 6.8% per year in real terms, adjusted for inflation, over the last 200 years. But 2/3 of that came from dividends. The remainder corresponds to the real annual growth in gross domestic product, or GDP, over the 2 centuries. The National Bureau of Economic Research study also demonstrates this very point. The stock market does not grow faster than the economy over the long term. If it goes too high or too low, it always comes back to trend. But stock prices fluctuate dramatically. There have been 7 secular bear markets and 7 secular bull markets since 1802, according to Alexander's way of looking at things. These are periods of at least 8 and up to 20 years when stocks are either generally rising or falling over the entire period. There are, of course, bear market rallies and bull market corrections, but the long-term trend is still either up or down. If you were in the stock market during the 95 years of the bear market cycles, you achieved only a 0.3% annual average rate of return. If you picked the 105 years of the bull market cycles, you made a 13.2% rate of return. Your actual returns for any one 10-year period would be totally dependent upon when you made your initial investment. On average, the cycle's duration from peak to peak is 28 years. Is there some model we can use to examine the long cycle to help us determine what drives the dramatic price movements? Here, Alexander provides a new way to look at price fluctuations. He looks at a ratio he calls P to R, or price to resources. Resources are simply the things, plant, equipment, technical knowledge, employee skills, market position, etc., available to the business owner to produce a profit. R is essentially retaining earnings, or that portion of profits used to invest in the business to grow the business, he writes. While P to R isn't particularly useful for predicting the performance of individual companies or industries, it follows a clear pattern for the market as a whole. P to R peaks at bull market tops and begins to rebound at bear market bottoms, as indicated by price. But the fluctuations in P to R are less volatile than fluctuations in the price-to-earnings P to E ratio. That's because while earnings may swing wildly from one year to the next, actual resources don't. Over longer periods, however, there is a direct relationship between earnings and resources. As the resources of a company accumulate and are put to work, the company's earnings tend to increase. The collective P to R ratio is the estimate of the value investors put on the ability of an economy to produce earnings. With this understanding, it now gets interesting, at least for me. And what we will see is that valuations at the time you invest determine the returns you will get over the next 10 to 15 to 20 years. Looking at cycles in terms of valuations is one of the keys to bullseye investing. Long waves explained, finally. Alexander then jumps to the long wave cycle. Greatly simplifying, the theory says that there are 2 sets of stock market cycles in each long wave. There are a bull market and bear market that are influenced primarily by monetary events. Those price movements are followed by a bull market and bear market that are influenced primarily by real events such as earnings and economic performance. The theory then says, the extraordinary gains in recent years result from investors discounting future earnings growth over longer periods of time. This makes the market extraordinarily leveraged to the economy. The average
Sample complete. Ready to continue?